Many first-time homebuyers in California make the same mistake. They wait for the perfect home until they're priced out of the market entirely. They inadvertently choose disappointment over equity. Hi, I'm Elsie Wu, and today we're breaking down the math of home affordability. But as you already know, this question of how much home can I really afford is more than math. Well, look at the lender's formula, advice from experts like Dave Ramsey and Suze Orman, and a powerful IRS tax strategy that can actually bankroll your future dream home. My goal today is to give you the framework and the tools to make an informed decision about how much home you can really afford and help you solve your own housing affordability challenge. Let's dive right in. First, let's start with the lender's math. Lenders use one primary metric, debt-to-income ratio, or DTI. Generally, Fannie Mae and the FHA want your monthly debt, including your new mortgage payment, under 50% of your gross income. That's your pre-tax income. In other words, if you make $10,000 a month in gross income, then your recurring monthly debt payment, including your new mortgage, property tax, and insurance, EITI, should not be more than $5,000 a month. But here's the reality check. Lenders only care if you can pay them back. Their formula doesn't know about your $400 utility bill or your childcare cost. Just because you're approved for an $800,000 loan doesn't mean your lifestyle can afford it. Now, let's look at what well-respected financial advisors teach us. Interestingly, both Dave Ramsey and Suze Orman are okay with 5% or even 10% down payment for a first-time home buyer, even though conventional loans generally want 20% down payment. This is because Dave and Suze believe it is important to own real estate to build long-term wealth. Yes, with lower than 20% down payment, you'll pay private mortgage insurance or PMI. But in California, that's often a necessary evil to stop the rent bleed and start building equity. Plus, the lenders offer first-time homebuyer credits, sometimes up to 3/4 off your mortgage rate, which can actually offset your PMI cost. Other differences: Dave Ramsey wants you to pay off your other debt before you buy your home. He wants your monthly payment to be no more than 20% of your take-home pay on a 15-year fixed-rate mortgage. Suze Orman is more flexible. She suggests keeping your payment under 28% of your gross income. She's okay with a 30-year fixed-rate mortgage as long as you're also saving for retirement. Whether you follow Dave or Suze, the key is to be honest with yourself. If your income is unstable, or if your industry is being disrupted by AI, or you're expecting to retire in the near future, budget accordingly. Think of buying a home like climbing a mountain. If you try to trek from the parking lot to the 8,000-foot summit in one single leap, you're going to run out of breath, your legs will give out, and you will likely have to turn back. That is what happens when you try to buy a forever home as your first home. The financial altitude is just too high, and the stress can be suffocating. Instead, seasoned climbers use base camps. Your first home, that condo or townhome, is your base camp 1. It's not the summit, but it gets you off the valley floor. It's where you catch your breath, let your equity acclimate to the market, and get your financial footing. Once you're stable at base camp 1, you don't just hike higher with a heavier pack. Use the progress you've already made to catapult you to the next level. Eventually, you reach the summit, your dream home, not by gasping for air, but because you climb the mountain in stages. The goal isn't to reach the top the fastest, it's to reach the top without falling off the cliff. Now, I hear it every day. I'm waiting for the interest rate to drop. But here is the counterintuitive truth. In California, where the job market is strong and housing supply is constrained, lower mortgage rates will just flood the market with buyer competition, driving prices even higher. You can't wait for a top-down solution from the governments. You have to create your own housing security, and you have to create it early. Remember, it's not just about buying, it's about owning. Your goal is a debt-free retirement where your housing costs are locked in, so you're not subject to rent escalations during your retirement. If you buy your first home in your 30s, then you will likely and comfortably pay off your 30-year mortgage before you retire. Now, let's talk about the tax-free housing ladder as a potential solution for this affordability challenge. Don't save for 10 years for an $800,000 dream home. By the time you save that down payment, that house will cost $1.2 million. You're chasing a moving target. Instead, use the IRS Section 121 homeowners tax exclusion as your secret weapon. IRS allows you to keep up to $250,000 or $1,000 for a married couple for your home's gain tax-free when you sell, as long as you've lived there for 2 out of the last 5 years. Here's a strategy that uses that tax exclusion. Start with a well-located condo or townhome or a small house. You stop paying your landlord's mortgage and start getting tax deductions. In 5 to 7 years, you take that equity you've built and that tax-free gain, and you use it as a bigger down payment for a bigger house or a better house. The IRS just bankrolled your upgrade. As of right now in 2026, there's no limit on how many times you can use this Section 121 homeowners tax exclusion. So the IRS is giving you a very nice tax break to build home ownership wealth in stages. Now, I can already hear some people grumble that they don't want the hassle of moving, that they want to buy once and that to be their forever home. That is certainly a very nice goal, but it may be unattainable for most people. Like that mountain climbing analogy earlier, you need base camps to get your financial footing. I can also hear other people saying that we should not count on appreciation. I agree. Think of all those condo owners in San Francisco who bought pre-COVID. Once the work-from-home practices took hold, many condo owners suffered significant devaluation. Many could not sell to break even. You should not blindly count on appreciation. You should be judicious in where you buy and what you buy. Look at the demographic pattern and buy what is likely to be in demand for years to come. Budget conservatively so you have the holding power during tough economic times. Buy properties that will hold value. Build your equity, and then seize the opportunity to upgrade if and when you experience a strong appreciation. Appreciation is a nice bonus, but don't plan on. Now, let's shift gear and do some quick math that you can use on Zillow or Redfin tonight. Search in your neighborhood for a home you might consider. On these websites, for each property, there's a mortgage calculator showing you the monthly housing payment, ITI, assuming a 20% down payment and 720 credit score. For example, an $850,000 house at 20% down and 6% interest, your monthly payment will be around $5,000. Multiply that by 2, you'll get $10,000 a month. That's the minimum gross monthly income lenders wants to see to approve your loan. Now, keep in mind that if you have car loans, student loans, or credit card debts, then lenders will want to see higher income. If it's a condo or a townhome with HOA fees, the lender will want to see higher income as well. If you're doing a 3% down payment instead of 20% down payment on that same house, then your monthly payment will still be higher than what Zillow and Redfin show on their websites. To follow Suze Orman's advice, multiply that monthly payment amount by 3. So if you see $5,000 a month of housing payments on these websites, then you know that Suze will want to see at least $15,000 a month of pre-tax income to approve that purchase. If that first home you find on Zillow or Redfin will have too big of a monthly housing payment for your current income, for your comfort level, then find a smaller home. Find a different type of home. Find a slightly further location. Find another solution until the numbers are comfortable for you. Now, let's talk about some more affordable solutions. Family gifts are great if your parents or your family can and want to give you a gift for a bigger down payment. That gift or down payment will lower your monthly cost. Now, many parents cannot. When my brother bought his home, our parents provided a small part of that down payment. He then paid them back with interest over 10 years. So my parents got a better return than a savings account, and my brother got a home. Another example, After the Great Recession, my husband Eric and I bought a triple-wide mobile home in Sunnyvale for under $200,000. It gave us a 4-bedroom mansion for a fraction of the cost of a conventional home, allowing us to focus on our job and our career and not be stressed about housing. Today, this mobile home is nearly paid off, and it has also doubled in value over the last 12 years. For you, that lower cost housing may be a condo, a mobile home, a duplex, or a roommate. There are also now formal programs that help friends or families buy together or co-buy with partnership agreements. Think of it as a prenup for homeowners. After all, 50% of an appreciation on a modest home is infinitely better than 0% of the appreciation of a dream home that you cannot afford. There are also now for-profit and nonprofit shared appreciation programs who want a more formal arrangement with institutional or government partners with well-defined terms. Many of these shared appreciation programs require no monthly payments for the portion that's shared by the institution. And because of that, that reduces your monthly cost and monthly stress. In exchange, they will take a pro rata share of the future appreciation when you sell or refinance. So there is definitely a trade-off. Bottom line is, open some doors for yourself so you can have more opportunities to say yes to solutions that work for you. Before you start shopping, try Suze Orman's Playhouse. Calculate your future mortgage payments. Some money also for monthly repairs and other costs. If it's $1,000 more than your current rent, save that $1,000 every month into a separate account for 6 to 8 months. If you can do it comfortably without breaking a sweat, then you're ready. If not, you've just built a nice emergency fund while learning your limits. To wrap up, don't wait for the market to change or for homes to become more affordable. Change your spot in the market. I'm here to be your strategist. Reach out to us to run your personalized numbers with us, and let's build your roadmap to homeownership.